All right, everybody. TGIM, everybody, and welcome to week 35, which I can already see we will have to adjust on the PDF that we actually do kind of send through. So much to kind of go through. I am joined today by my colleague Raymond Chung from our Hong Kong office, who will be covering the Greater China segment from our global sales kind of trading team. There will be no charts in this week's kind of version. I just wanted to focus on potential kind of ripple effects, maybe what to kind of watch out for next. It goes without saying that things are super dynamic, and we've seen how quickly things can change in the whole U.S.-China riff, if you will. But definitely it is that kind of Monday morning that starts off in Asia where you definitely want to be putting on your helmet, strapping your seat belts, and preferably be rolling in the tank because it could get a little bit hairy out the door. We are currently now talking with S&P futures down around 80 basis points, NASDAQ 100 futures down about the same. That's a pretty big move for kind of an Asia session. We have dollar yen actually off the lows. We're down about 23 basis points. At one point we're down about 40. We're at kind of 105.15. US 10s making new lows at 148. And US 30 is at 198. We still have bunds have not opened up. They closed on Friday at 67 and a half negative bips, and we have JJB's minus 26 kind of bips as a whole. So what we're going to catch on is what happened last week, what I think could maybe be happening next, and then maybe potential kind of assets of kind of playing that. Most of this is a lot more medium to kind of long term, as tactically you can make a lot of arguments for mean reversion kind of squeezes, overextensions, so on and so forth. So just kind of bear that in mind. And we basically have this backdrop of QE for life. I think that is completely kind of unchanged for now. And then, of course, potentially the only thing that can really structurally change things in the near term, at least, is on the fiscal policy side. But typically what happens is things have to get worse, a lot worse, before they kind of get better, before you see a big kind of fiscal policy response. As always, everything is solely views and opinions. These are not trading, no investment recommendations. So it really kind of boils down to two kind of key things, at least from a global macro perspective last week. All kind of came down to kind of that Friday tussle. We saw China raising tariffs on U.S. goods. This was right before the Jackson Hole Friday speech, where everyone was anticipating what Powell would say, as well as a few kind of other central bankers. And we had a pretty strong kind of also quick response back from Trump, who also counter-raised on tariffs as well from the U.S.'s kind of side. And, you know, one, I think, thing that's kind of very clear to me is this has basically opened up a ceiling on dollar yuan, right? We're about 716.70 now, up about 50 kind of basis points. Whereas, and I think maybe before you could have said, okay, we broke 7, maybe 720 is kind of the most. I mean, to me, this now just kind of opens up that to be, whether you want to call it as being weaponized, whether you want to call it as being a currency kind of manipulator, depending on what side you're on. You should also bear in mind that if there's any currency manipulator out there, it's really the Fed in the U.S., which started this whole QE game post the GFC. So they're kind of the OGs of all of this, so to speak. But you know, the only thing that I think can really dramatically reverse dollar yuan upside is, you know, a big turnaround and a conciliatory solution-oriented Trump. And this may just be something that we cannot expect to see until early maybe next year, or maybe, if you're very optimistic, late kind of this year, you know. And that again would be kind of coming from the thesis that part of his whole re-election ploy is to come across as having struck a better deal with kind of the U.S. and China. But it's also very possible that you know, he wants to kind of double down and take a different kind of route towards kind of solving the problems that he's kind of created, at least compared to previous administrations. We had Jackson Hole. Powell was very kind of balanced. I'm actually paraphrasing a lot of these from comments that our chief economist, Steen Jacobsen, had made. There was something for the hawks, something for the doves. Risk is to the downside and very much kind of linked to trade. Yet outlook on the economy is favorable. So I think now post kind of the events and also the kind of sell-off that we saw on Friday, and we're going to see a ripple effects of the digestion of that, with people expecting more escalations, as what tends to be in these cases, is you know, that 50 basis point cut, which had originally been discussed for September, but kind of petered away given FOMC minutes, given some of the comments that came through. This is probably going to be coming back, as is also the chance, I think, of an intra-meeting cut. So these are definitely things to kind of take away. FOMC minutes from last week were really kind of a wash. There was not too much of a mover. We did see U.S. yields move up initially post the minutes, yet we obviously lower off of those levels on Friday close, and of course this morning in Asia. We're still not at all-time new lows on U.S. 10-year rates, I should say. That was 131.80 or 132 if you just want to round that off. That was in 2016, but we have taken out the August 2016 lows early on this morning in Asia. And then we see a little bit more focus in regards to kind of inversion. We had an intraday inversion on US 2s and kind of 10s. We're basically about 0.92 basis points right there at the moment. I thought it was quite interesting that the dollar had a big kind of weak move on Friday, especially if you're kind of looking at the DXY. Whether this was really a combination of Powell's comments on risks, Trump again going after the Fed, basically saying who's the bigger enemy? Is it Powell or is it President Xi? I mean, that's pretty as visceral as you can probably get. And again, also just implying that the Fed is the big kind of cause of a lot of the headwinds that the U.S. is seeing because of kind of the stronger U.S. dollar, saying that he would accept a resignation from Powell if it kind of came. Expect a lot more of that structural attack from Trump, from the White House in regards to kind of trying to kind of weaken that institution. Whether or not it's for changes that they would like to do later on, again, hard to say, but that's just not going to let up anytime soon. Very, very easy scapegoat for the president to kind of use. On commodities, again, it's gold and silver continue to go to new stratospheric heights. These are basically probably going to end up as being probably the best high conviction calls that we have ever kind of made on Macro Monday. We are flirting with new levels, with you're just shy of 1550, and you could argue that with silver, potentially having room to kind of get above that kind of 18 kind of handle. Equities again was sold off with the majority again of the selling, over 100% of the reversal last week, really all kind of occurring on Friday. So interesting to kind of see that, and this here is kind of the weekly kind of column. Actually, parts of Europe were still up, but I'd expect a lot of that to kind of reverse later on kind of today. And obviously on the vol side, it was Hulk Smash, almost 20% kind of uplift on Friday, but still kind of south of that kind of 20 handle. I would expect kind of that to continue on. Just moving quickly on kind of the COT side, maybe a little bit less relevant given that these are obviously of the close of last Tuesday and we've seen an escalation, but still interesting to see kind of the trend. Weakening US dollar longs from a basis, which is interesting, down about 12%. And the chart here will probably give you a little bit more kind of an appreciation of what's been kind of happening. So the blue chart here, or line should I say, represents US dollar net longs. So, above zero, it's positive. Below that, it's negative. And actually, what's interesting is we've actually had this structural kind of decline in dollar positioning, but you just wouldn't think that when you're looking at kind of broader kind of U.S. dollar strength and things like kind of the DXY. And of course, this is based on the COT report. So it'll be interesting to see if the move we saw on Friday, and I've heard that from a few people saying that we've had now a few risk-off days and the dollar does not grind higher, whether that's some kind of implication of the structural high in the U.S. dollar and the cycle kind of being there. We'll only know in kind of how the next kind of few weeks to maybe a few months kind of play out. And again, more dramatic moves in hedge fund kind of positioning on the commodity kind of complex. As we flagged last week, we had already had a 50% reduction over 3 weeks, and now we're having 40% lower just over kind of the last kind of week. Which again is counterintuitive to the positioning that we're seeing in kind of the US dollar, but maybe not the strength and prices that we've kind of been seeing. So I think the key focus kind of this week is really going to be US-China trade escalations, the ripple potential effects of that. Overall, it's definitely more accommodative monetary kind of policy. I'll have another slide here post Raymond's 2 slides that will kind of delve in kind of what my top of mind thoughts are in regards to the escalations. Of course, this week we also have China PMIs, which should be coming out coming Saturday. That's going to be key. 49.7 is expected on manufacturing. It's been in contraction now for quite a few months. 53.6 on the services. And then we, of course, have the second reading on second quarter U.S. GDP, which has basically a 2% kind of handle. We also have personal income, personal spending, core durables, Richmond Index, and don't forget the fact that it is kind of the last week of the month. So potentially Thursday, Friday, we could see some window dressing kind of effects, some dollar flows. And worth bearing in mind that coming holiday on Monday is Labor Day in the U.S. So there's actually a long weekend coming up in the U.S. Potentially could see some liquidity constraints around that towards the back end of the week. And speaking of holidays, the UK has a bank holiday today, and we also have G7 meetings finishing up today. So maybe there could be something that kind of comes out of there that's quite key. Not too much on the Fed speaker side. From an FOMC perspective, it's only Bullard that's speaking. Quite a few people have been getting kind of confused on the dissenters, and people calling for cuts, people saying we shouldn't cut. The dissenters are you have to be an FOMC member to vote, not just a Fed member. So the dissenters from the last meeting basically advocated no moves, and we have other non-voters who are basically advocating for 50 kind of basis point cuts, sometimes even kind of more aggressively. So just to kind of clarify on that. From a central bank perspective, again, or at least from a major central banks, only Bank of Korea, South Korea's national bank. Again, as we've said many, many times, the skew is surprising to cuts, right? If anything, I'd be surprised here if they don't cut, actually. So this is probably something that should kind of change. And another thing to watch out for really is core durable goods, always key in the U.S. And Australia has quite a lot of data due this week that basically kind of deals with underlying kind of construction, building, new home sales, etc. With that, let me please pass it over to Raymond to catch us through what's happening in kind of Greater China, what he.
Okay, thank you, Kay. Hi, good morning, everyone. Today I'm going to go over what's gonna impact on the market when China decided to escalate the trade tension. I believe over the weekend everyone has been talking about what China is going to do and how Trump and the U.S. is gonna respond to the latest escalation of the trade war. So let me reiterate what is going to encapsulate in this latest action. So over the weekend on Friday in Asia time, the Chinese State Council decided to increase the tariff from 5% to 10% on 75 billions of US goods, but that it's going to be implemented in two different dates or two different batches. The first is September the 1st and the second is December the 15th. So when we talk about trade war, we usually talk about 5G and technology, how it's going to impact in the long run. But another sector that is going to be impacted to a substantial degree is the auto sector. And for this round, the auto sector will be suffering a 25% tariff for all the US autos that is imported into China. And for the auto parts and components, there will be an additional 5%. These incentives were previously paused in April, but then given all the escalation or given all the intensification between US and China, I think it's time for China to take a second thought and try to reinstate what they were trying to do. So I think one of the key things for us to notice is that the timing for the announcement, it came right before the Jackson Hole meeting and also the G7 meeting in France. So meaning that it's gonna be giving everyone kind of a surprise call in the wake of all the meetings and all the discussions that is happening on a very high level. It sends the market two key messages. The first of which is that China or Beijing is getting intolerant to see the repetitive tariff moves suggested by Trump. And it is something that China has repeatedly seen that they don't really have the tolerance to endure or to suffer any more random trade tariff increase. And also there was a scheduled meeting in September, but given all the different actions taken from both sides, we can really think about whether this meeting will really go ahead as scheduled. Chances are that the meeting will probably be cancelled or at least deferred to an even later stage as the trade tension is getting heated. So for this week, I would want to go over more about the impacts that is going to be placed on auto sector. So from auto, Tesla and Ford are among the top exporters of US vehicles to China. So meaning that in the previous rounds of trade tariff or trade conflict intensification, Tesla is one of the most suffered exporters in the US. But something that we might want to take a look at is that the Gigafactory 3 plant in Shanghai. The project started off earlier this year in January, and it broke ground for about 10 months ago. And now the factory is about to come to fruition, and it's going to be completed in a very short run. So the speculation is that the factory will be up and running by the year end, which is about 3 to 4 months away from now. The benefits that it will give to Tesla is that when this factory is up and running, it can help the Tesla to increase the production by 3,000 units per week at the initial stage. That is going to alleviate a lot of export pressure from Tesla. Most of these made in China vehicles will be sold locally in China so that they can actually avoid the increment in the tariff, and that is going to help out the income for Tesla in the short run. And apart from Tesla, we might want to take a look at General Motors and some other auto names which have joint ventures with Chinese company. When these companies have a venture in the local country, they can probably increase their production scale in the country, meaning that that's another form of evasion from the tariff in the long run. So on the right-hand side for the slide, it's going to showcase about what is or how is China going to implement the tariff this round. This round, they are trying to implement 75 billion divided in between the two dates. The scale and the volume of this tariff on US stock is actually the highest from among the two previous the previous year. For the first batch in September, agricultural products, antiques, clothing, and kitchenware will be among the US goods that is going to use a higher tariff. And on the second stage by December, smartphones, laptops, technology, and also crude oils, pork and bean, which is mostly consumer products, and also cottons and farming products, that's also going to see a higher tariff by December. So we may expect like a 3 to 5 months for this whole impact to be played out. So this is my sharing for this week, and I am now passing it back to Kay.
Thanks so much, Raymond. These are kind of top of mind thoughts that I kind of initially have, as always, retaining the right to change my mind at any kind of one point. I think the key thing to really watch out for here is, kind of going back to Raymond's, those dates of September 1st are key, and as well as kind of December kind of 15th kind of as a whole. So I think when you have a situation that we've seen unfold as we have so far in the markets, you have to kind of begin by appreciating that the recency bias tends to lead us to extrapolate on momentum. So i.e. seeing more what we have kind of been seeing as kind of a whole. So that's one thing to kind of take into account, right? I think, the other thing, though, is to note that everything that we're seeing here is happening pre, US 210s inversion, which is always, something that is linked to recessions. This is all pre-global recession, pre-US recession, pre-German recession, at least technically speaking, as well as pre kind of further escalations, right? We obviously saw a big focus on Trump's regrets over the weekend, and that was actually him trying to clarify that he was regretting that maybe he should have hiked more on the tariffs on China, right? And I guess, September 1st, which is obviously next Sunday, we could see a response from the U.S., but we could maybe even see a response from the U.S. going into that, which could be interesting. So maybe on Friday the 30th or even that weekend and so on. But it just doesn't really look good in regards to kind of how September is going to start out and the third kind of quarter as a whole. As you know, with that said, it could be that maybe the third quarter we actually get towards peak bearishness in regards to kind of trade tariffs and relations and so on and so forth. But we'll kind of have to wait and see on that. I will say that you know, there's a lot more of an impactful measure that China could still take on U.S. companies operating in China. Obviously, you know, we've discussed previously how Apple has, you know, 20% of its revenues from there, so on and so forth. There can be things from patriotic kind of boycotts to also just outright U.S. companies losing license, you know, making the business very, very kind of difficult for them and so on and so forth. I will note, maybe on a controversial perspective, it's worth thinking whether Trump is maybe actually the best thing that's ever happened to China and perhaps the world. And from that, you know, this is a thought that Forrest and I were kind of discussing kind of last week on the Macro Monday. The headwinds that Trump is forcing is actually making it easier for China to kind of carry through kind of some structural reforms that maybe would have been harder if things were not as dire. And this is always just something that we just see globally, right? Real hard structural kind of reforms tend to have the best probability of being passed during kind of dire straits. So this, again, it could just be something that's a lot more kind of long-term, a little bit of devil's advocate, but also has quite a bit of long-term kind of ripples. We've already talked about, you know, two maybe trading worlds, two different logistic systems, one that faces China, one that faces the U.S., two separate maybe even internets from that. But I think one thing that a lot of people have not thought of, and definitely Trump has not thought about it, but I would think that some of the most switched on people in the Treasury and the Fed should be thinking about it. And that is, of course, the push towards an alternative payment system that's not driven by the U.S. dollar. Right, and that I think is something that China could spearhead and spearhead quite aggressively and quite robustly, saying, "Hey, you know, who wants to kind of be tied towards being, you know, in essence, linked to the powers that be from the U.S., from a stronger U.S. dollar, from the SWIFT kind of payment system, and so on." I think this is a huge, huge, huge theme that's only going to be picking up more speed, more kind of traction. I'm hearing it more and more and more. There's different ways that China could do this with partnering up with Russia, Iran, but I could also see other parts of the world, maybe even Europe, to be honest, joining in on kind of that and having kind of a different alternative to kind of what the U.S. has been basically exploiting, as we've kind of really seen with this kind of Trump administration. So that's a big, big game kind of changer. And then, of course, we also know that the central banks of China and Russia have been buying gold in record numbers. So if they were to, let's say, get some kind of common currency, back it with gold, and then have people be able to kind of exchange into gold or into other kind of commodities, right, with the commodities underlying actually being in either yuan or the ruble or some kind of combination of both, that would really, really start to kind of change the powers that be in regards to how the heartbeat of global macro works. Again, September 12th, September 18th, very, very pivotal. These are the next dates for ECB, where we already know Draghi was, you know, talking about more stimulative kind of measures, more accommodative measures from a monetary policy perspective. That's all pre-escalation. Fed, again, I think we're getting back to 50 basis points coming into play, and do not rule out intra-meeting moves if things proceed to maybe kind of get worse. We are now 2824 and S&P futures down about you know, 1.10% and 122 on the Nasdaq 100 at 7414, and this is just early kind of Asia session. The pressure again for central banks to be much more accommodative only increases. RBNZ's a surprise cut of 50 basis points last week, a few weeks back, sorry, you know, really makes them kind of look like rock stars, and it's really hard to see how anyone can kind of buck the trend. So, you know, all the people who potentially have not moved, such as Bank of Canada, etc., you know, will be under that kind of much more pressure. I still think that, you know, for key response in regards to economic kind of structural change, it has to be fiscal, preferably coordinated globally, even though that's hard to see now. But normally things have to get a lot worse before it gets better. And the one place to really watch is, let's say, Germany from that kind of perspective. But I still think it's a world where the meta trade and trade is for yields going down and eventually dragging down volatility and eventually kind of inflating all other asset classes. I think clearest winners, as we've said many times, it's a core longs and precious metals. Multi-year new highs are on the way. Core long and duration. I was a little bit shocked here, to be honest, and I'll paraphrase the story where I was speaking with a CIO, big family office, over $500 million, big allocation to bonds, and they were kind of celebrating how much kind of money that they've made with bonds and basically exiting their duration exposure, and I was just really, really shocked. And this was actually happening when U.S. 10 years were still above 2%, not even this, sub 1.5%. My whole point here is, if you think U.S. 10s are expensive at, 1.5, go back and think where we are once we're into kind of global recession, once we're into kind of, further kind of fallouts, and this business cycle again is stopped running on fumes and is just kind of coming to kind of a natural end. I think Bunds, could easily get to minus 100 basis points from these minus 68, and US 10s could easily get sub 100 basis points, before all of this is over. And I just do not think that these are aggressive moves. Yes, we moved a lot in a very, very short amount of time, and it's been pretty much a straight line, but that is still very much the meta trend, which I say, you always want a core position. You can trade around it if you want, but leave a core exposure kind of to it. And I'm really shocked that a lot of people still don't appreciate this. A lot of people still don't appreciate that we've not hit any escape velocity from a negative yielding kind of world. It's only going to get worse. And of course, key longs and the likes of yen and the Swissy. I think equities, again, this is, the tougher part, especially kind of tactically on the timing. But I still kind of go back to yields pushing things down is going to inflate assets up on a medium to kind of long-term basis. At least for now, it's going to be pretty much a lot of what we've seen for potentially the next 6 to kind of 18 months, right? So where it starts to get interesting is on pullbacks. We're about 6% from recent highs, maybe a little bit more if you're looking from the futures, but this is on S&P cash. And it starts to get interesting once we are minus 10, minus 15, and definitely minus 20% from the top. Minus 20 was kind of where we got to in the fourth quarter kind of last year, right? Before we had that very, very dramatic and harsh kind of bounce back. And of course, if the indexes are doing that, then you can imagine some of the single stock names are, down 15, 20, 30, maybe in some cases even 40% if we do end up having a big move like that. So definitely for the stock pickers amongst you that are a lot more medium to long term, the value players, you should have a radar list of, good companies, cash flow yielding, strong balance sheets, moats, businesses that maybe even have nothing to do with kind of trade, consumer kind of staples types, and things like healthcare where people will have to spend recession or no recession, so to speak. I think lastly on weaker kind of economic momentum globally. We saw kind of the PMIs last week. They weren't exactly, the flash PMIs last week, they weren't exactly kind of stellar. It's worth remembering that 2020 is an election year in the U.S. We have Tokyo 2020. We're also potentially likely to see finally some kind of move towards fiscal stimulus by Germany. Then this is assuming that things continue to kind of get worse. That will eventually force them to kind of act. And of course, in the summer of 2021, we have China's 100-year anniversary for the party. So there are quite a few things structurally that are kind of, you could say, big ticket items globally that could force people to keep throwing things at the business cycle to keep it kind of extending. But sooner or later, the price has to kind of be paid, as is always the case. It's never different this time. I will say one other thing, and this is more kind of in the near term. There's definitely seems to be a lot of bad news out there. From even conflicts and noise in the Korean Peninsula, things out kind of in the Middle East, geopolitics, potential also auto tariffs coming in Europe, and so on and so forth. But at some point, it's soon going to be hard to see how things get much worse. So just watch for maybe this exhaustion, this kind of peak bearishness, so to speak. I don't think we're necessarily there yet until we're kind of on the other side maybe of September kind of 1st, where China puts the tariffs kind of into play, and see if we've gotten some kind of reaction kind of back and forth. And with that, let's maybe just end it there, and I will stop the recording, and we can kind of move back to some